Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Khang to discuss finance and investing, portfolio management, household economics, and much more. Kevin is a financial economist and the head of active and alternative research at Vanguard's investment strategy group. Our conversation focuses on the main areas of Kevin's research, including active portfolio management, portfolio construction, direct indexing, tax-aware investing, retirement, and household finance. Kevin is doing a lot of interesting research on these topics and thinking about how to apply it in the real world for investors at Vanguard. As always, thank you for listening. Please enjoy this discussion with Vanguard's Khang. Hi, Kevin. Thank you very much for joining us today.
Pleasure to be here. Thanks for having me.
You have an interesting and diverse set of investing-related research spanning from active management and portfolio construction, tax-aware investing, direct indexing, and then retirement research and sort of like personal or household finance. And there's a lot to uncover in each of those topics. But we're going to try to sort of use the research that you've been putting out, which is excellent, sort of as a springboard for the discussion today. And hopefully that arc is where we can sort of get into the details on some of this stuff. And by the way, most of Kevin's research can be found on his personal website. It's kevinikang.com. We'll put a link to that in the show notes so people can access any of those papers. And so thanks again, Kevin. This is going to be a really great discussion. Wanted to just talk a little bit about your career path, I guess, and how you got to where you are at Vanguard. So you are currently the head of active and alternative research within Vanguard's strategy group. So can you just talk a little bit about sort of your path to that role?
I was an econ major in undergrad and really enjoyed just the whole discipline of economics. And so pretty early on figured that, I would basically go all the way in terms of training, academic training. So it was almost a no-brainer that I ended up in a grad school at Northwestern doing economics and finance, pursuing that at the graduate school level. And then met a number of really wonderful mentors there, but then increasingly over the course of that sort of a graduate studies career, felt that academic research is, although it's very rigorous, the connection to the real world and the kind of impact that you can have with academic research was always a bit more tenuous than just I'd like it to be personally. And then now kind of looking back with the benefit of hindsight, I feel that if you kind of stay in that academic track, then you can have a lot of impact later on as a consultant for policymakers and in other capacities. But at the time, coming out of grad school, my interest kind of had firmed up that I wanted to be in the real world, so to speak, outside of academia, and kind of look for a place where I can apply the research kind of capabilities that I had, just gotten better at through graduate training. So with that, I landed in this, maybe not the best known industry called economic consulting. So what that is, you're basically doing bespoke empirical research within the context of commercial litigation, so usually behind the closed doors, or pretty large scale government driven regulatory investigations. So you're dealing with a lot of typically big name corporations. Again, in that setting. And then, I spent a few years there doing that consulting and eventually wanted to kind of switch out of there and transition into the buy side, where I could actually apply the research skills as well as just empirical finance background in a more maybe actionable setting. So since then, before coming to Vanguard, I spent a number of years with State Street Global Advisors, and then briefly with BlackRock before coming to Vanguard to join the quantitative equity group as a risk manager. And that was 6 years ago. So I've been with Vanguard for about 6 years. So within Vanguard, I've switched the group once. So now it's no longer the quantitative equity group that I'm part of. It's the investment strategy group, which is the internal think tank within Vanguard. So we kind of lead the thought leadership work, which is why, as you mentioned, I do a decent amount of research in my day job. And also we serve as an internal sort of a consulting organization within Vanguard.
How do you pick your areas of research? Is it more like internally driven, you're identifying these areas and then you're investigating, or is it driven by sort of questions you're getting from others at Vanguard on areas that they are interested in having you research? Because you've kind of carved out like these 4 or 5, main areas that you're focused on, and maybe that'll expand over time. Yep. But just how do you determine where you're spending your time and research on?
It's kind of all of the above, and just kind of it depends on the season, I guess, that we're in. So, one of the reasons that I think we're going to cover this in a little bit, but one of the reasons that I've been pretty productive in the tax loss harvesting area is because, Vanguard as an enterprise was interested in understanding that, a little better. So that there is a sort of a strategic element and force behind understanding, some of these topics. And then I think for me, I also just kind of have a running list of questions that I'd like to answer, if I have the time and resources. So that list is always evolving. And so for me, it's sort of a combination of the two. So part of it is just my formal mandate coming from the role that I have. And then the other part is usually whenever I work on a project, I try to kill more than one bird with that particular project. So I look for an angle. Can I bring this other maybe related set of questions into this particular research project? And so that's, I try to kind of, in a way, try to maximize, give an opportunity that way.
We've had a bunch of people who have published research papers on the podcast, but what struck me when I was preparing for this is I don't think we've ever talked about that actual process, what it looks like.
Yeah.
And I know it can be a pretty extensive process, from coming up with an idea to writing something to maybe eventually getting it published in a journal. And I'm wondering if you could just talk about those steps and kind of how long it is and what's involved in it.
Yeah, so I feel like a typical research project maybe takes anywhere between, I think a good number is about 6 months to kind of go from the conception stage of the idea to actually then kind of think of a research design, which is basically, at that point you're making a bunch of decisions. Like, do I want to go with a simulation? Do I want to go with a back testing? Do I want to go with more kind of empirical, like at the investor level data, or do I want to go with something else? So I think those are, there are a number of decisions that I think we probably just don't even think about it when we make those decisions, but those are like, it's a long list of decisions, I think, once you try to like codify it, and then just turn it into process. So those decisions are made reasonably early on, and I think that's actually maybe an underappreciated area for the success of research, because I think if you don't make the right decisions at that time, and I've made plenty of not so great decisions, then you kind of like go down the wrong end or wrong path or the dead end, and then you don't end up learning much. So, but that's the initial, maybe I want to say in the first 3 innings of the research, and then it's followed by maybe a few months of just pure execution, and then you'll have the results. And I think at that point, once you have the results, there's a decent amount of feedback loop that goes on between looking at the results and then are these really answering the question that we had in the beginning? And again, oftentimes I feel like half the time the initial thinking that I had or the hypothesis I had are wrong, or at least they're not very right in light of the results. So there's a decent amount of just refining your thinking that goes on with it. So the way I look at research is it's a journey, and like it kind of comes with the emotional aspect to it, because there are always inevitably time or even a month where you kind of feel like you're stuck on a particular part of the research, and you're not really seeing the end of it. But eventually, if it's a successful project, then you'll get through that. And then anywhere between 6 months to a year is what I think is a decent amount of time to finish the research, turn it into a writing, and then iterate it a few times. So that's kind of the typical estimate I have for a project.
How do you think about the publication part of that? So I guess you have to kind of decide, do I want to submit it to a journal? Which journal do I want to submit it to? And then from what I've heard, the editing process with the journals can be a very challenging one and a lot of back and forth. How does that part work?
So within the kind of practitioner journals that I typically submit our work to, there is actually a decent amount of variation, and I meaning the editing process and the refereeing process actually has a decent amount of variation, at least in my personal experience. So, on some papers I submitted, I heard back reasonably quickly, and then they turned into publications. Again, within probably just a matter of maybe half a year, which strikes me as a pretty speedy. And then on the other end of the spectrum, I had waited for more than a year, back and forth with the referees. So to me, that again, and then it took additional probably like 6 or 7 months for it to actually come out, to be in print. So there's a reasonable, I feel like, amount of range. And then in terms of where do we decide to submit it to? We kind of feel like, I think our strategy is just kind of understand what the journal is about and who the kind of readership is and how engaged they are. And then just it's a function of our understanding of what we want our work to be, our paper to be, and then what kind of impact we'd like to ultimately have. So that's how what we try to factor in.
You mentioned your work on tax loss harvesting, and that's how we actually found you. We found you in a Wall Street Journal article about your paper, Tax Loss Harvesting: A Portfolio and Wealth Planning Perspective. And a lot of people know that there are benefits of tax loss harvesting, but a lot of people don't take a deep dive down to understand like where those benefits are coming from. Mm-hmm. So I'm wondering if you just a high level, can you talk about your research in that paper and what you found?
Yeah. So, tax loss harvesting. Well, maybe I'll take a step back and then just talk about tax loss harvesting, what it is.
Sure.
Briefly. So tax loss harvesting, I think the idea is, I think the idea is to simply put it, if the life gives you a lemon, then just make a lemonade. I think that's really what tax loss harvesting is, in its essence. So if you're owning a risk asset that you think is going to appreciate, so for me, the best example is S&P 500, broad-based U.S. equity index. I think we all believe and know that it's, I don't know if we know, but I think generally believe that it's going to over time appreciate. And most people have that conviction, otherwise they wouldn't be in that investment. But as it goes up, certainly inevitably there will be periods where it's actually underperforming, and not only is it underperforming, it's probably there are times where you have unrealized losses. And it's in those moments where you could there are a couple of things one can do. Number one is just basically don't panic and then realize that it's all part of the journey, hold on to it, and eventually you'll just ride it out, the volatility. But the other part of it is, as you do that and as you kind of don't lose sight of that long-term investment objective, accept that the losses could be used to offset some of the gains that you have on some other part of your balance sheet. And that's basically what tax loss harvesting is. You're kind of banking losses along the way of an appreciating asset. Just to kind of give you a quick rundown of the list, the return environment, so that is, generally speaking, is it an upward trending environment or downward trending or sideways, as well as the volatility environment, turn out to be really, really important factors in terms of how much efficacy you can kind of get out of tax loss harvesting. And those are also admittedly kind of beyond any investor's control, right? We just work with what we have. So the other factors that are just as important are basically the investor profile, investor characteristics. So are you a high tax rate person? Is your ordinary income tax pretty high right now because of your income level or not? Are you someone who's able to continue to invest, like add more cash flow and invest into this risk asset along the way? Or is this more of a one and done kind of investment? That's another important factor. And then most importantly, how much capital gains do you actually have on the side that you could use the losses you're going to harvest with tax loss harvesting with? And that turns out to be kind of like the biggest predictor of your tax loss harvesting benefit.
Yeah, that's something I think a lot of investors miss is, we're realizing all these losses, but if there's no gains, then, they're not all that valuable to us. They can only be taken a small amount every year.
Correct.
I think a lot of people miss that. They want to like realize losses, and, they forget that other part of the equation.
Yeah. So, I mean, that's why, and they kind of, again, maybe this is where, the fact that I'm doing research with a great co-authors here at Vanguard, I think probably had an impact on the way that paper came out, because the work that we do, we always have to kind of think back on like who are we doing it for? And at the end of the day, it's the individual investors. Just that's part of the firm's DNA. And looking at the whole taxless harvesting from that point of view just really crystallized that point for us. Whereas I think in the past, in the literature, most people had just assumed that, oh yeah, you have an unlimited amount of capital gains to offset, which I think it can be the story for mutual fund, like tax managed mutual fund management story. Yes, you will have a lot of capital gains to offset, especially if there are a lot of outflows. But when it comes to the individual investor level balance sheet, it's a completely different story. So we think that's a really important factor, and we think that that thinking should really figure into deciding how much you want to kind of allocate to taxless harvesting to begin with.
Yeah, I think that's a cool thing about doing the research at Vanguard is, a lot of times in an academic environment, the real world doesn't come into it that much.
Correct.
And, so things get missed in academic papers that kind of are not the way people apply these things in the real world. But by doing it at Vanguard, you're sort of bringing them both together, the real world and the academic environment.
Yep.
In your white paper on this, you have a chart that's called the relative importance of TLH alpha drivers. Mm-hmm. And I'm wondering I don't know if you have it in front of you, but I'm wondering if you could just walk through these, because I think this is really interesting. You've got a bunch of these different things here, sort of in their relative importance. So
the relative importance of TLH alpha drivers, it just really quantifies kind of what I had mentioned earlier. So I think it shows that average return environment turns out to be driving about 25% of all the variation in taxless harvesting. And that's so true. So maybe just to kind of contextualize a little bit, imagine someone who maybe had $100,000 to invest in S&P 500, and then with the intention of basically taxless harvesting. And then let's just do a thought experiment. That person starts investing, put all of that money to work in the beginning of 2000, like year 2000, just before the dot-com bubble burst. Compare that person with somebody who does the same exact exercise in the beginning of January 1993. So I imagine you both are very familiar with the next 10 years, what they're going to look like for the two individuals. The person who started in 2000 is going to go through the next 3 years, basically having a non-stopping taxless harvesting opportunities, up and down, generally down, but then up and down, up and down. So you're going to be constantly pushing the cost basis down because you're going to be taxless harvesting so much. And by the end of the third year, so basically by the end of 2003, if you look at your portfolio, it's going to be basically like it's going to be the cost basis. There will have been no gain, no capital gains, because it's been a bear market, and then you will have harvested about 30 to 40% of your initial investment in losses, which is phenomenal at the end of the third year. Imagine that person basically then offsetting all the capital gains they will have, and turning that investment into, reinvesting it back into the S&P 500 in 2003, coming out of the bear market. The returns are going to be phenomenal because now the market's actually, reverting back to the mean, which, with some pretty high returns. So that person's taxless harvesting alpha will, in many cases, be over 200 basis points annualized, just because it was a wonderful time to be taxless harvesting, generating losses in the very beginning, and then coming out and kind of catching a very strong reversal, reverting market back to the mean. Compare that person to the 1993 person who will basically invest the money and live for the next 7 years, a very boring volatility, like testing single digit S&P 500, but generally a strongly appreciating market. That person's not going to have much of an opportunity to tax loss harvest to begin with. It's going to be much more limited. It's not going to be as much as the 2,000 person, year 2000 person. And then as a result, tax loss harvesting alpha will be more muted. So the return environment turns out to be one of the most important kind of drivers for determining the scope and impact of tax loss harvesting to begin with. So volatility and return environment, I would say, kind of collectively account for almost half, a little less than half. And then the remaining part is all driven by the individual characteristics. So it'd be, again, how high your tax rates are that you can apply your losses to translate them into tax savings. And it'll also be around your cash flows. Like, can you actually continue to refresh and renew higher cost bases? Because there's a difference between someone who just basically invests once and then not, and then that's the end of it, versus someone who actually continually renews the cost basis. And then again, most importantly, your total amount of capital gains that are coming from other sources of your balance sheet that you can actually put your losses to work.
Yeah, it was interesting. We started doing some tax loss harvesting we had a couple new clients that we did it for in 2022. And that was actually an amazing time to start doing it. You had these market losses and, who knows what the future returns will look like.
Sure.
But, going back to your original point, two things had to be true. Number one, we got a down year to start, but for people who don't have those gains, then the value is not going to be realized right away. So it's just interesting. There's so many factors that go into this that people have to consider, and they sometimes miss them.
Yeah. No, I agree with it. And I think from a financial advisor's point of view, and even just an individual investor's point of view, that the whole timing issue, I think, is another interesting thing. Some people, especially if they are kind of closer to the ultra high net worth, just balance sheet, capital gains rich kind of folks, if we're kind of talking about that segment of individual investors, generally speaking, they have a steady sort of a source of capital gains flowing through from some other places, right? Compare that person to someone who just basically generally has a W-2 based income, right? Labor income, and they don't have a ton of capital gains unless capital gains are distributed from their, maybe active fund holdings or something like that, where the capital gains distributions tend to be a little more pro-cyclical. We're talking about two very different types of investors, and the tax loss harvesting, the speed, the rate, the pace at which the tax losses that are going to be harvested in these bear markets get translated back into the investment will be different between those two types of investors.
I guess a good logical progression from tax loss harvesting is the idea of direct indexing. And you've written some stuff about that as well. That's becoming a big thing now for investors. You're seeing a huge increase in people using those types of strategies. And you had written an interesting paper where you looked at the difference between using individual securities versus using something like sector funds for direct indexing. And I'm wondering if you could talk a little bit about what you found there.
When we took a look at the sort of landscape of the industry of direct indexing, there was actually a surprising amount of variation in terms of how it was being implemented. So direct indexing typically is understood as, instead of owning a commingled vehicle like S&P 500 ETF, you're actually owning the individual ingredients, individual single name securities that make up that, particular index you're interested in. And the way it's typically implemented is you are holding an optimized portfolio. So if the universe that you're interested in is S&P 500, then you're not exactly owning all 500 securities. You're owning maybe 150. And the tracking error of that, your direct holdings to S&P 500 ETF would be pretty minimal to start with. So that's the way it's typically implemented. But then when it comes to tax loss harvesting, there is a decent amount of variation in terms of how often people actually check for losses. So some folks would do more frequently than some others. As well as the granularity of your holdings with which you're doing the tax loss harvesting. So instead of owning, for example, 150 securities to, in a way, track S&P 500 index, sometimes people would be owning just sector funds or ETFs. So given the variation, along both margins, we basically decided to look at, okay, what difference does it make when it comes to tax loss harvesting efficacy with both? So for the frequency of scanning for losses, we went from annual, and I know that maybe sounds very slow moving, but then it's actually, I think, practiced by some in the investment management industry, so it's relatable. So annual to quarterly to monthly to daily. And when I say daily, it's not daily harvesting, although it could happen in times like last year where it's a lot of volatility up and down. It's just basically daily scanning, just so that you're not missing an opportunity that may be a little more fleeting, and that may not be there if you were to check it monthly or quarterly. So that's the kind of, how often do you check for losses? And then the other piece was around just the granularity, again, from a commingled fund, where the only source of volatility for loss harvesting is time series. In other words, if you bought an S&P 500 for $100, it needs to go below that 100 in order for you to actually tax loss harvest. And then, the only way you could do that is basically for that ETF to actually go down in value as a collection, versus, again, owning an individual securities that make up S&P 500. So what we found is that compared to the sector funds based tax loss harvesting, using the individual securities, so that's the more granular piece, and then exploiting the idiosyncratic volatility that individual securities have to tax loss harvest can add north of 50 basis points, additionally, maybe about 60 basis points of additional alpha to tax loss harvesting. So that was a sort of a substantial enough difference. In terms of the frequency, we also found that the ability to check for daily losses over monthly and quarterly, especially over quarterly, could potentially add additional 25 basis points. So those were kind of the quantitative aspects of what we found. I like having found those, I still think the most important insight from that work is that it's actually when the differences in methodology make the most difference. So it turns out that, you remember the 1993 person scenario that we're just kind of touching on, like the person who was going to start doing tax loss harvesting without knowing that the next 7 years ahead was going to be just a very low volatile kind of, high appreciating market. From that person's point of view, those are the environments when tax loss harvesting with what I would call the industrial grade strength. So basically checking for losses on a daily basis, and then with individual securities matters the most, because those are the environments when volatility are just hard to come by. And those are also the environments when, generally speaking, from all of your other financial assets, you have a lot of capital gains distributions. So the marginal value of loss harvest that you can have, which is hard to come by, is actually greater. And those are the moments where checking for losses on a daily basis is kind of like of a lot of value, because just because you're seeing that potential realized losses, unrealized losses today, doesn't mean it's going to be there, 2 weeks later when it may have been your time to check it if you're doing it, at the monthly frequency. So to me, that insight was kind of just as valuable as the quantification of what additional value, these different modes give you.
Yeah, it's interesting how far this stuff has come. Like I remember back in the day, people on like December 15th or whatever would just, realize their losses for the year and move on.
Right.
But like now, if you think about something like 2020, you use that annual year-end approach, 2020 never happened, basically.
Correct.
You weren't able to realize any of those losses from that major decline. So yeah, I could see how frequency is a big driver here.
Yeah, I mean, 2020 was another great example, and then I think in a very similar vein, 1987 is kind of like, it's kind of in the same boat where you had a window in the middle of the sort of a calendar year, and then by the end of the year, it was gone.
How do you think about direct indexing in general? It just seems like there's a wide range of opinions on it. You've got people who are proponents of direct indexing that say, you're getting 1-2% of tax alpha. Then you've got people on the other end saying, the ETF is the most tax efficient vehicle in the world. Like eventually, you might get that tax alpha at the beginning with direct indexing, but eventually it's eaten away by fees and stuff. And, you end up better off in the ETF. And I'm sure this is very case dependent on every individual person, but I'm just wondering how you think about that.
So I think if I heard your question correctly, I think it's sort of like, on one hand, there's that alpha figure, right? TLH alpha figure, north of 100 basis points, which I think is a pretty fair number. And then on the other hand, there's a question of what people call ossification, which is at some point, your portfolio kind of loses has a very, its ability to generate losses basically plateaus. There's a couple of things. One is cash flow, the role of cash flow. I think it's very important. And then the other one is, direct indexing, maybe not thinking about direct indexing in isolation, but thinking about direct indexing in combination with all these other potential ways to be tax efficient. So maybe let me start with the cash flow piece. It works at continually renewing cost basis of your investment. Then I feel like a lot of these concerns around the plateauing effect of taxless harvesting are not as relevant. You will continue to have enough of investment with high enough cost basis relative to where the market is to be able to get enough benefits from taxless harvesting. So that's number one. I think the other piece around more of a thinking of a taxless harvesting and direct indexing in a more holistic sense. Again, this may not apply to everybody, but from an individual, investor standpoint, if they combine that with, for example, gifting, then it can actually work pretty beautifully. So what you would want to do is you would basically want to gift some part of your holdings that actually have the most embedded gains, and therefore it's most tax efficient. And then here the assumption is that you will have additional sort of incoming cash flow from somewhere else where you can then kind of reallocate to the same, perhaps direct indexing allocation to replace that exposure to S&P 500 if that's what you were tracking. And then the cost basis there would be much higher because so if you can combine that with gifting and then again with the assumption that you have additional cash flow coming in, then some of these concerns can be less of a concern. But
yeah, that's really interesting. I hadn't thought about the gifting thing. Like when you combine those together, that's actually a pretty powerful combination.
Yeah, I mean it's sort of then I think of it as kind of like win-win-win for everybody. But again, I don't necessarily think that applies to everybody, right? There will be some cases where you just kind of want to be doing lump sum investing and then hope that lasts, but that won't be as effective in terms of tax efficiency as combining it with gifting.
I wanted to shift and ask you about factor investing. That's kind of our bread and butter. And, you wrote a really interesting paper because one of the things I would criticize myself for in my career is I'm always trying to optimize things. I'll go crazy with these fancy optimization strategies. Yep. And at the end of the day, I'll realize like the simplest thing I started with was probably better than any optimization I came up with. And, you wrote this paper, How Inefficient is the 1/n Strategy for a Factor Investor. And I think you kind of got at this idea. So I'm wondering if you could just talk about what you found in that paper. Yeah.
So what drove us to, write that paper to begin with is that, first of all, there's a difference between what some in the industry as well as in academia do refer to as factors, and what factor strategies are more generally available to the kind of the broad-based investment public. So what we mean by that is, generally speaking, the most popularly available factor products are long-only products. And generally speaking, they also tend to be kind of there tends to be a distinction between factor investing in large cap space and small cap space. So we just kind of want you to acknowledge that there are those kind of real world implementation differences when it comes to factor investing to begin with. And then what was also important to us was that the last 10 years, with an explosion of all these sort of factor investing vehicles, we kind of felt like there was really no viable benchmark for how to actually measure, your allocation two-factor investing. So that was kind of the genesis for the paper. And then what we did in the paper was basically we kind of set out to work to combine to kind of like test different optimization strategies, as you said in the beginning, Jack. So we took mean variance seriously, but also not literally, and made sure that we would only consider, for example, portfolios made of factor strategies that are only kind of like realistic, that people would actually put money to. In other words, we didn't really think about complicated kind of long short strategies using factor funds. So we consider that, and then another kind of common strategy is minimum variance strategies. So we consider that, and then as you kind of mentioned in the beginning, there is a one over n strategy, just the simplest of all strategy that we considered. And then what we found from the paper is that 1 over n strategy actually works surprisingly well in both large cap space as well as small cap space. And the couple of reasons for that is once you actually account for the transaction costs that kind of eat away at the factor premium that we know, then it actually hits momentum factor for obvious reasons a little more than, basically reduces that premium a little more than the other factors. So quality and value, those are the other two factors that we looked at. And that's number one. And the other one is factor kind of premiums are not terribly easy to predict. So if one were to kind of use an arbitrary, well, let's look back and then just use 10 years, worth of average premium to then kind of guide us in terms of how much we want to allocate over momentum relative to value and quality, for example, then that strategy turns out that, it doesn't really work terribly well. That additional kind of information, one feels that one can get out of looking back doesn't work terribly well because, and this is kind of related to another factor paper that I wrote, because factor returns in general are, the factor premium kind of is concentrated in maybe like 1/3 or so of a given 10-year period. That's where a lot of the overall average premium is accrued. So in light of that, when we looked at the 1 over n strategy just basically performed much more steadily and robustly compared to all these other strategies that were kind of trying to basically read into the prior 10 or 20 years backtesting records and inform the portfolio construction based on that. So that's the kind of high level takeaway.
Yeah, it's interesting. Like if you look at the value factor, that's a good example of what you're talking about. Because if you look at 2000 to 2003, if you didn't own value from 2000 to 2003, like you've missed out on a very, very, your returns over a very long period are going to struggle because it just came in such a short burst.
Correct.
As we kind of get towards the end here, Kevin, I wanted to shift and talk to you about some of the research and work you've done around retirement and financial planning. And one of the pieces, and I think this was out there recently in the media, was this research you've done on retire and relocate.
Yep.
I think you and some of your peers at Vanguard were looking at this idea that retirees can move from maybe high cost states and actually use some of their home equity to help fund their retirement. And then you actually had some numbers behind it in the terms of types of savings or the money that somebody might have access to if they actually did migrate from, a state like Connecticut, where Jack and I are in, which is a pretty expensive state for retirees and just expensive in general. Mm-hmm. And so just if you could talk to what some of the findings of that research paper were.
Yeah, so that paper was motivated by kind of we just wanted to understand the extent to which people were using their home equity. And it kind of came from the understanding that, more than half of Americans don't have a ton of liquid retirement savings. And yet they are still retiring. And then I guess the big question is that we don't really know how well and exactly what's funding, those retirements. And you put the two and two together, and then they start asking the question of where is that, retirement funding coming from? And the obvious candidate was housing equity. And so that's the question then was, okay, how are people using it? And then the literature before our work generally points to the narrative that people don't move much in retirement. And also people don't touch their home equity much, even in retirement, unless something dramatic happens where your spouse passes away or you have a health issue in old age. And then people actually start kind of dipping into their home equity. So we just thought that story was not complete. And again, it's one of those things where you just form a hypothesis and kind of go to data to either support our thinking or to then or disprove it. So that's kind of where we started, and then what we found to a bit of our surprise was that actually a very huge share of people who are retiring between at the age of 65 are generally moving, or a lot of them are moving, I should say, not everybody. And then of those who move non-locally, about 60% of them are actually moving to a cheaper place. So if you kind of like do the math and add up how big this can be, it turns out that about 1 out of 4 retirees in a 10-year period could be kind of going through this. This as in potentially moving to a different place upon retirement. So the typical example we have in mind is moving from Boston to Florida or Connecticut to Florida. And the typical savings, again, this is all estimate because it's all based on average home price, and we're not exactly observing the individual house prices associated with this move. But the typical saving is on the order of about $100,000. And that, again, this is kind of coming from the entire population. So $100,000 should be compared to about $250,000 of retirement savings, a typical retiree has. So it's a very significant amount compared to the other retirement funding they have at disposal. And then obviously on the higher end, it's a much higher number. So that's what we found.
Yeah, I mean, I think that's an important thing for a lot of retirees to be considering, especially if they are in high cost states, especially those that don't have much in retirement. And there's a lot of people out there like that. So I think that's an interesting piece of research. I also want to ask you about the work that you've done on safe withdrawal rates in retirement. So you kind of looked at these, what safe withdrawal rates might be under different return assumptions, different market environments, whether or not a bear market starts when you first retire. So I was just wondering what some of your conclusions were from that research.
It's an interesting topic, and it's also, I think, one of those topics that just kind of get a lot of attention every time there's a bear market because, and I think that's just a testament to what we have, what retirement in America has become, which is it used to be that it was very defined benefit driven, defined benefit based system where people didn't have to pay attention to the ups and downs of the market. Whereas now a lot of people actually have defined contribution based accounts, and they, in a way, have a portfolio to manage the risk of, even in their retirement. And then what we found is that to the extent that people are generally just withdrawing from an investment portfolio, then you have a trade-off between not wanting to withdraw too much because that basically eats into the longevity of the portfolio itself, and therefore potentially could be, putting your retirement stability at jeopardy, versus not drawing enough out of concern that, well, if I am really concerned about the longevity of the portfolio, then I will just be very conservative with the withdrawal. So that I think is the trade-off that a lot of the retirees potentially face with their investment. And that trade-off is also arguably heightened most if you retire and then all of a sudden the bear market hits you. So that's kind of described in our paper called Safeguarding Retirement in the Bear Market. And there is really, in most retirees, if they don't have a lot of buffer in their portfolio, then they're really between a rock and a hard place, because you thought that you had a certain amount and you could withdraw a certain percentage point and that would be good for your retirement. And all of a sudden that portfolio is down 10%. And then every dollar you withdraw in that point at that moment is actually worth a lot more than a dollar you would withdraw in other times, because the expected returns on that portfolio that just took a hit in terms of losses is higher because you're in the middle of a bear market. So what we find is that generally speaking, it's not a good idea to be withdrawing as casually or as steadily as one had planned in those moments. That it's a good idea to actually try to protect your portfolio during that time, and to the extent that they can, maybe adjusting their consumption during that time is also another very important thing that we'd recommend people do. So that's number one. Another kind of related thing that we've looked into on that topic is, as we're anticipating certainly lower return environment going forward, and this is kind of coming on the back of having gone through a very healthy return period. Again, maybe it doesn't feel like that after a year and a half of kind of bear market, but it certainly was up until, the end of 2021. And if we look back, the sort of a post GFC return environment, it certainly was a wonderful time to be an investor. So coming out of that environment, and as we look out with the outlook of, how is the return environment going to be potentially shaping up, the return expectations are not terribly high compared to especially what we are used to. And in light of that, the question is then, okay, given that, and we're not talking about just a bear market here and there, but we're talking about a decade-long return environment. If our expectation is that stock market returns not going to be as high as what we are accustomed to, then what does that say about the sustainable withdrawal rate for retirees who will, again, have to balance withdrawing a comfortable amount, but at the same time also protecting the longevity of their portfolio. And what we're finding there is that the viable sustainable withdrawal rate in a low return environment will be certainly lower than 4%. Maybe it'll be more kind of aligned to 3% range. And, that number could be even lower still if there could be, if we're thinking about more of a downside sort of a return environment scenario.
I thought it was kind of good in the paper too. A lot of investors hear about this 4% rule. So you can withdraw 4% of the portfolio down each year. And with a balanced allocation, probably there's a chance you won't run out of money. But you kind of pointed out in the paper that, there's all these different types of investors. And, it's not like it's the same safe withdrawal rate like for everyone. You really need to understand kind of where you are, the probability of success, the type of investor you are, and kind of mold the safe withdrawal rate around sort of you as an investor. It's not the same for everyone.
It's not like every investor has 25 years or 30 years of life expectancy after retirement. And it's not like every investor has only that investment portfolio to look to for retirement funding. So everybody's different. And the housing paper that we just talked about, retire and relocate strategy, could be part of that big picture. Everyone's in a way different, and their composition and their sources of retirement funding could be quite different. So there is certainly that need for customized thinking. And really these numbers, whether it's 4% or 3% or 2%, is really just the, one of probably several building blocks in thinking about, what makes a good retirement and withdrawal rate.
So we like to end all of these podcasts with a standard closing question, and that is, based on your experience in the markets, if you could impart one piece of wisdom or teach one lesson to your average investor, what would that be?
This is something I may have said earlier. I think there is a lot of wisdom to be gained and extracted from kind of looking back at the history and just from an investment standpoint. Imagine that you're kind of living through that era. Imagine that you're living through that kind of period as if you're doing it in real time. And kind of almost like anticipating how you would react in especially market defining moments, and being prepared for those. So one thing I think that we all can be sort of certain about, having lived through even, whether it's 10 years, 20 years, 30 years of the market environment, is that there will be times where, downside risk it'll look like downside risk is kind of like all we see. And there will be that temptation to then to want to react to it in a way. But then if your investment plan and practice hasn't been sort of like grounded in your philosophy that is actually really deeply rooted in that understanding of what these, what I would call tail environments feel like, then I think that there's sort of a downside risk of doing something, reacting to that in a sudden way that is not prudent only goes up. So being prepared for that downside risk environment and kind of really knowing yourself, I think is actually probably one of the most important things to be able to actually realize and experience investment success. So I would just call it maybe guarding against your kind of worst self in those moments.
Very good. Thank you very much, Kevin. This has been great. Really appreciate your time, and all the best.
It's a pleasure. Thanks for having me.
Thank you.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.